Hi, good morning, Neeraj. Yes, Apollo Tyres is on my list, but let me first off cover Morgan Stanley on Adani Ports. Continues to remain bullish. In fact, they believe that their estimates for FY29 need to be revisited, need some amount of a revisit on the back of the 5-year plan being ahead of the estimates that they have based their numbers on. In terms of what the 5-year plan seems to indicate, well, 1,000 MT in terms of FY29 expected target volume. They're also expecting port revenue to double and EBITDA also to double. So ROC, they believe, of all major ports is targeted to be above the 20% mark by then. The logistics revenue and EBITDA growth is likely to be pushed further higher, and their consolidated revenue, EBITDA and free cash flow target growth is expected to be 2.5 times and 2.3 times for the latter two, which is EBITDA and free cash flow from the current levels. Of course, there are risks to the downside as well, specifically volume growth if slower than expected, more intensity with regard to pricing competition, value dilutive acquisitions could also play spoil spot, and an increase in related party exposure that may also play a bit of spoil spot. Those are risks on the downside. That's Morgan Stanley. Quickly moving on, Nomura on Apollo Tyres. Q4 results were largely below estimates according to them. They were impacted by lower revenue. That's one. Second is extended producer responsibility provisions have gone up, which is what has impacted the numbers. Now, Q4 volumes were marginally higher. You're also seeing market share gains, especially in the replacement segment. Rather stable numbers overall on that front. But the focus on profitability over market share likely to have a tepid impact with regard to the top line number according to Nomura. So only a 6% growth projected by them on a CAGR basis to FY26. But price hikes and focus on better mix should improve margins, hopefully, is what they are believing, and margins could normalize at the current levels, which is FY24 levels. Free cash flow generation likely to remain strong all the way through FY26 is what they believe. But the upside here, and that's where they've changed their rating, they've upgraded, is on the 14% decline in the stock price over the last 2 months or so versus a flat index. And therefore, they believe there could be a possible upside, and therefore they've upgraded to a neutral, 512 being the target price.